All right, as I've been saying ad nauseum, the missing piece for me early on, and I think for any trader out there, especially somebody who's very new to trading, is to somebody to actually show you real trades ahead of time. Okay, look, I'm going to take this trade. I'm going to get in here. I'm going to stop out here, and here's my initial profit target. Anybody can cherry pick a few big winners, and yeah, I do that a little bit in some of these presentations. But the bottom line is, and I do also show you everything from the trading service, good, bad, and indifferent over the past, I don't know how many years I've been doing the methodology in action, but for quite some time, even before it was called that. But anyway, as I've said again and again and again and again, seeing someone many, many, many years ago actually make trades and actually be profitable at this was very important. So let's do that. All right, let's talk about the mystery charts and the methodology in action. So this is a gold stock, TFPM. And it was a really nice uptrend. And also, if you look back here at accelerating uptrend, I would recommend you go back to these old shows, older shows. So in this case, you go back to April and early May to see some of these stocks that triggered way back then. By the way, for those of you who are new to me or my methodology, I'm slotted as a swing trader because that's what I put on one or two of my books in the title. But the reality is I'll hold a stock as long as it moves in my favor. And as long as it moves in my favor is defined by being stopped out with a trailing stop. Anyway, entries there, stop down there, initial profit target up here. And this is one that's rallied up and died out quite a bit. And somebody in the Facebook group was saying they read where your best trades are profitable from day one. Well, yeah, that's probably true. But if you got out of every trade that went against you as opposed to following the plan, you never would catch any big winners. And it seems like trades always kind of go against you. And it's something I'm kind of trying to flesh out. There's an old adage on the short side, all shorts initially go against you. But on the long side, too, quite a bit, you will get some backing and filling. The timing doesn't always work perfectly in this game, as you know. So a lot of these things that are kind of neat to know, you aren't really applicable. And I think, if anything, they could put you into a state of regret because you're thinking like, oh man, I'm in this stock 2 weeks and I'm losing money. And I read where you're supposed to be profitable from day one. Well, in an ideal world, yeah, but a lot of times stocks will back and fill a little bit and then take off, and that's perfectly normal. Anyway, so in this case, rallied up, hit the IPT. We banked 1K per 100K. The model account is based on 100K. Stop comes to break even. So the worst you could do, barring overnight gaps, would be to scratch out on the remainder. And so far, so good. In this particular case, we survived the drawdown. Now, one thing I want to get into eventually, maybe after all these trades end and things quiet down for a minute, and we could be quieted down with the market kind of going through this transitional phase as it is now. But I do want to catch up on some things, and I'll show you a little bit of this in a minute. But like, for instance, up here at 34, you had a lot more money than you did down here, okay? Now, knock on wood, and probably today notwithstanding, but knock on wood, this stock has come back quite a bit since, and I hate to use the word hope, but hopefully we've survived this correction. And ideally, as that stop widens out over time, you survive these peaks, these troughs and pullbacks along the way. But anyway, so far so good in there, knock on wood. And let's see, there it is right there in the portfolio. I mean, this is a day or two old. But you can see pretty good run on the first low, 950. We're shooting for about 1,000. It probably triggered on a slight gap, if memory serves. Yeah, it did, about 10 cents higher on the gap. And the good thing about this one is that we got in at a fairly low price. It was in the teens, and now it's in the mid-20s. And this is how you could build wealth over time. And we've had a few run quite a bit, like this INUAI. Now, this one's actually pulled back quite a bit. But you can see 100%, 114% was open here. If this turns into, let's say, we could dream, right? But if it rallies like 10 points or so, then you've got 1,100 shares and change. That's a lot of shares I have open. So even right here at 500 shares, if this thing goes into the 30s and 40s, et cetera, that could really become a huge position over time. And that's the ultimate goal with these, is to hang on as long as possible. So here's KGC. Here's the one we just looked at in the portfolio. There's all the parameters: entry 1450, stop 1250, initial profit target at 1650. Under members resources, on the members area, you can grab this spreadsheet if you want. It's going to be blank, but you can put in all your information. You'll be using the same exact spreadsheet as me. And so all you need right here is your entry and your protective stop, and then the IPT, the risk, and everything else is calculated for you. Anyway, this is another gold stock. And again, go back to April, late April, early May, if you want to see these when I first talked about them live. Entries there, stop down there, initial profit target. This is another one that was dead money forever. I've done plenty of presentations just on this one, and others like it, but it finally hit the IPT, so you bank $1,000 when that happens, and then you trail that stop loosely on the remainder. Now, this one came dangerously close to that trailing stop, and this is a testament for follow your plan. I mean, provided it goes on and bangs out some new highs. But so far, so good that there in the golds. And usually golds don't really trend that long. It's like you usually get a big euphoria in the golds, and everybody kind of forgets about them. They move on to other areas. They don't become these longer term momentum stocks as a general statement, but gold has done really well for quite some time. Okay, I want to talk about discretion versus no discretion. Here's a trade I did use discretion on, and I actually didn't take the trade, and I'll show you why. So this was a good looking setup, though. Nice persistency, nice acceleration. This is a fairly clean trading stock, or really clean trading stock for one of these crazy digital mining type of stocks, crypto type of mining stock. Anyway, so there's parameters down below. Entries here, stop is here, initial profit target is up here. And let's see what happens. So it rallies up, and on this day here, and I've talked about this quite a bit, and if you can't sleep at night, go and watch prior presentations. But on this day here, when a market closes strongly, like toward the top of its range, like right here, there's a really good chance it's going to follow through, but there's no edge after the open. Okay, that's based on Connor's research, and I've seen it quite a bit. So everybody that brother is buying going into the close, and some people who didn't get it on the next day, they're like, oh, I might have missed it. They see it's higher, they just pile in, and sometimes that creates an opening gap reversal, like it did here. Now this one was fairly cut and dry. It gaps open, it comes right back in. So I made a discretionary call, and I did not take the trade. Now, if you took the trade because of the gap opening, you got it a little higher than intended, okay? And then you lost a little bit more than 1K per half loaf, so that would be 2K total plus 89.89. So it's like about $2,200 loss on the trade. Okay, it happens. Not everything works, obviously. You can see we're risking 2% on 100K. So that's $2,000 per trade. Our risk got a little bit out of line, but that's okay. Now, the ultimate goal, obviously, is to make 1,000 in the first loaf and then hang on to the second loaf. And you can see right here, 141% gain, and hopefully for a long, long time. We'll come back to that one in a second. So it did give up some of those gains. Anyway, here's another one that I use discretion on, but I wanted to show you that sometimes discretion is a good thing, and sometimes it doesn't work, obviously. So anyway, there's the parameters down below, NRGV. So entries here, stop is here, initial profit target is up here. Now, it gapped higher and made kind of a fast move on the open, but then came right back in. So in a case like this, it just kind of barely got above the entry on a fast move, and it comes right back in. So in a case like that, usually I let things open a little bit, and sometimes I'm forced to jump in if they keep on going, if they open up and keep on going. But a lot of times you'll get these reversals very early in early trading, and the ultimate goal is like no capital gets put into harm's way, like the Hive trade. Because of the opening gap reversal, I didn't take the trade. Now, if you did take the trade, like somebody in the Facebook group was saying, oh man, I took it, that's okay. If that's what you're doing, if you're following things sort of mechanically, and if you're new to my methodology, or if you're newer to trading, I would highly recommend you follow something that's a little bit more, or follow something on a little bit more mechanical basis. So I give you the entry to stop, the initial profit target. Then by all means, look at that plan and use that plan, and that is your plan, okay? If you're a little bit more advanced, then you can make these opening gap reversal in other type of discretionary calls. Now, this gentleman was like, oh man, I took the trade. It's like, that's okay. If you're following things mechanically and that's what you've been doing, keep doing that. Be consistent and continue to do things mechanically. Just begin to learn slowly, okay, and methodically about how and when you might be able to use a little discretion to improve results longer term. So he was bummed out that he took the trade. I was like, don't be bummed out. You made a decision. This is a decision. You're going to live with that decision, as opposed to like get out later in a day, okay? Don't do that. Don't make too many decisions. Make your one decision going in and then stick with it, good, bad, or indifferent. And you can see the next day, nice rally higher, okay? This is a one-day wonder, unfortunately, but it rallied up, hit that initial profit target, came right back in. So that's a 1K move per 100K, 26.67% in one day. That's much better than the poke in the eye. As I preach ad nauseum, if the worst you ever did, and believe me, you're going to do worse, okay? But if the worst you ever did was the better in the poke in the eye trade, and then you caught a few winners along the way, you would own the world within a few years, okay? So nothing wrong with the better than the poke in the eye trade. I like to scream next after I catch one. I did not catch that one. So in this particular case, on the model account at least, I saved myself a couple $1,000 at least by not taking one trade, but then I was unable to participate in this other trade, okay? Now, I do try to follow things as mechanically as possible, but because I've been doing this for a while, I will use discretion when I think it's necessary, and especially if it's fairly obvious. And I will put that out in the Facebook group that, hey guys, be careful on this one. I'm going to go ahead and use some discretion or whatever. The other thing I do too is if you can't sleep at night, go in and watch the service archives. And I just updated them, davelandry.com/archive, so you can check them out there. You could also get the newer ones on YouTube, youtube.com/Dave Landry. And if I say so myself, it's a good exercise in going through these trades and what I'm saying beforehand. And like on that one that was very close, that closed very high in the range, you knew there's a high probability that stock's going to gap open, but you don't know if it's going to hold and keep going. So you got to be really careful around the open in those type of situations. But I go in the night before, if I see a potential discretionary thing happening for the next day, especially like on a strong close with the entries really close to the close, then I'll point out to everybody, hey guys, here's a heads up. You're likely going to have to do some sort of discretion on this trade. So anyway, for those who follow mechanically, it turns you a better than the poke in the eye type of trade. Now, this is one, and I didn't get this chart updated, but this is from last week, but I'll show you what's going on here. So that was the parameters, a couple thousand shares, and then I'm pointing out it's crazy. It is crazy. HV is like 300 and something on this one now. So entry, protective stop, and initial profit target. Now, here was one of those one-day wonders where you got paid in the first day, which is really nice. However, I'd actually prefer stocks to sort of take their time within reason getting to that profit target, because it's very hard to sustain a 30% move or whatever this is on this particular day. And you can see it came back in a little bit, but fortunately we were able to survive with a protective stop. Now, this is left over from last week, as I said a second ago, and that number has come down significantly. So now it's 26.56, 116% open. Now, that's tough, letting those open profits draw down like that. But if you want to participate longer term and you want to catch, now it's kind of elusive, but the occasional, and I know I'm not supposed to say it's elusive, but it can be the outliers. But that's what we live for, and that's where our money is really, really made, okay? But if you want to catch the occasional 500%, 1,000% trade, you have to be willing to live with those open profit drawdowns. And that's something that I preach quite often. Curtis Faith was talking about Richard Dennis. And when the Turtles, who were a group of traders they put together, it's like I forget that people don't know who the Turtles are. I read the First Market Wizards. But they they made a lot of money. They were in the right place at the right time. And I don't want to take too much away from them, but a lot of them had a hard time with the trend following afterwards. But anyway, long story of this, Faith was saying that Dennis was okay when somebody had open profit drawdowns, losses to open profits, because he knew that came with the territory. And it's kind of hard because we all kind of mentally monetize, up at this peak here. I forget how much money it was, but it was a lot. Okay. And you're like, oh, I got all this money. And then the next day, or by the end of the day, you're giving up thousands of the money. So of those profits, I should say. So it can be tough, but it comes with the territory. Now, it's just something that you have to learn how to live with. And that's something that I want to flesh out over time, all the nuances of how hard it can be mentally to do this. But once you understand, it's like, okay, this is a fact of life. I'm going to have to deal with this certain aspect. And it doesn't make it super easy to deal with, right, when the time comes, but at least you're expecting it. All right. Any questions at all that? I don't even know how to get the questions now. So we'll have to see. Is this questions, chat? Okay, we'll see. Maybe it'll come up. Here we go. Questions. All right, fantastic. All right, we had a pretty good opening gap reversal last Friday. And this chart, as I've been saying quite a bit, is kind of a textbook. This was an actual opening gap reversal. I forget which trade it was. Maybe LMNN. I don't remember. But anyway, this is kind of textbook in nature. Okay, nice persistent uptrend. Stock's just going straight up. It falls completely out of bed. Okay, finds its low and then rallies back by the end of the day. So this is the KRMN. And you can see that this stock was at a really nice longer-term trend. If you back this chart way out, that trend goes back forever, okay? With some consolidation in between, but for the most part, it just worked its way higher for a long, long, long time. Now, it gaps lower, and it's great in these situations where they gap lower and then keep on going lower without a significant rally, because that makes the trade a little bit more of a no-brainer. And you can see it reversed and had the mother of all rallies, like about a 5 or 6 point rally. Now, this is a 5-minute chart. I'm going to show you a 30-minute chart in a minute, and that's what I've worked my way up to. As I've said ad nauseum, I was trading E-minis once, and I was just kind of chasing my own tail for day after day after day, and make a little, lose a little, make a little, lose a little. And then I fat figured the chart somehow and put a 15-minute chart on as opposed to a 5-minute chart. And I went about 3 days without a trade. I made a trade, made a little money. And then a few days later, it's like, what? How come I'm not getting any trades? I was chasing my tail the last few weeks. And then it finally dawned on me that I was looking at a little bit longer time frame on the chart, and I wasn't getting sucked into the flickering ticks, so to speak. So I now use a 30-minute chart, just FYI, on intraday. I try not to do too much intraday trading, but a day like today, the market starts coming unglued a little bit. I might buy some inverse shares or short some futures. And you got to be careful doing that, because you don't want to do that and lose money and add insult to injury. But sometimes you can kind of mitigate the damage a little bit that's happening from the open profit drawdowns and from the outright drawdowns that happen. Anyway, so I'll put it out in the group as a potential ogre in KRMN. Now, I'm sitting there watching it, and here's the thing. There's a few lessons in this, okay? One lesson is, as bad as you want something to work, in fact, the more you want it to work, the more you have to be willing to walk away. And so I'm looking at this thing, and I'm thinking, this has got it has like a 2-point spread, and there's hardly any trading volume on the day, okay? So everybody's just kind of sitting there trying to figure out what's going to happen. And so I'm like, okay, well, I'm not going to take the trade, but what I am going to do is I'm going to put some alarms and alerts in there, and I'm going to keep a loose eye on it to see if things begin to pick up a little bit. And that spread begin to squeeze in a little bit, or a lot of it, and then the volume begin to pick up, so I have liquidity. I don't care about volume, or don't try to use volume as a predictive device, but if volume is too thin, I don't want to take the trade. So I want to make sure there's some other players that are playing along with me. Anyway, so initially I said the spread's too big. And then a little while later, when things tightened up, I said, hey, this happened kind of quickly. So I ended up saying, oh, I'm long now. So I just let everybody know that I changed my mind on it. We're long. And then I hit the initial profit target, and that's to smoke them if you got them there. So anyway, let's take a look at that. Now, again, this is the 5-minute. We'll take a look at the 30-minute in a second. But you can see almost a textbook kind of opening gap reversal. It had this one little tick up, but then kind of implodes. So it's like, okay, right there, it's like, okay, now we're in pretty good shape. So we got an opening gap reversal, or I'm sorry, we got an opening gap, and then it doesn't reverse right away. It begins to sell off. So that makes everybody think this thing's going to zero. So psychologically, it might pull in some more people. It might pull in some shorts. It might pull in some people to dump the stock who are long, like the heck with it. I'm just going to get out before it gets any worse. And when you have a reversal after the initial fake out, sometimes that can be the real deal. Now, I'm just kind of thinking about this out loud, and it was Kevin Haggerty years ago, and he told me that when they get a new guy in the office, Kevin's no longer with us, but when they get a new guy in the office, he would they wouldn't let him take the first signal. Okay, he had to take the second signal, and he missed a lot of trades. Okay, he is a metaphor, whatever, but whoever was new in the office missed a lot of trades. But the trades that they actually took did a little better, okay, overall, higher probability type of trade. So if you're trying to get into the opening gap reversal business, maybe you wait for the stock to gap lower, keep on gapping lower, okay, and then begin to take off. The old adage, the early bird gets the worm, the second mouse gets the cheese. And sometimes these second mouse type trades can do really well. But anyway, opens, sells off hard, tries to rally, comes back in. Now, just looking at a 5-minute chart, and again, if you're on a longer term chart, like a 30-minute chart at least, this becomes a little easier, but it's like it gaps down and it looks like it's coming straight back up. Well, you got to be really careful not to jump in. Ideally, depending on the width of the bar, but ideally, you want to see if that first bar in early trading after a sell-off can be taken out. So anyway, it begins to rally up, and then I waited for it to actually break out above that opening gap range. Okay, so I got long here, and like I said in the Facebook post, I only did 100 shares. I did do a slightly larger position at other accounts, and I did more of a set it to get it there, and I'll discuss that in just one second. But because I was just long only 100 shares in this particular case, I just put it a trailing stop of about 2 points, and I just let it go. Okay. Now, when I was up about 5 points in the stock later today, it's like, Dave, even though it's a small share size, it's kind of, there's a temptation when you're trading smaller size, like, just screw it, just let it go and see what happens. But I thought to myself, it's like, well, you don't want to start getting a little bit pregnant here and there. You can't get a little bit pregnant. So it's still best practice to still take partial profits, even if you're on a small position. Sometimes I'll do I'll have like an S&G trade, 2 contracts on something, some options or something like XSP or something like that, a 0 DTE. And I'll just think to myself, Dave, you only have $20 in this trade. Who cares? But then I was like, no, I'm going to put in an order for when I'm up $40 on a trade to take off half the trade so I get a free ride. And that sort of conditions me to keep doing the right thing. That's a good rep, as I talked about ad nauseum. Go and watch those presentations if you have time. But trading is all about getting the reps in, but they have to be good reps. It's not like chasing your tail and hitting the button like the rat for the cocaine or whatever. It's more of getting a good rep in, trading in a conceptually correct manner, getting your money management down, getting your mindset right, accepting is a big one, accepting the open profit drawdowns and all those other features, so to speak, that come with trading. But anyway, so I was like, you know what, Dave, you're up $5 on this, and the initial profit target should have only been 2, okay? So that would have been $100. But I was like, let's let it ride. It's 100 shares. You could debate that like it just did. But ideally, you do want to follow a plan, even at small size. And then I was out the rest on the close. Now, last week, I talked about the run, Popil, Showtime, rotisserie, set it and forget it, chicken cooker, right? Type of trading. And I did, in another account, use a 2 points. I had a couple hundred shares, not a whole lot, but I had a couple hundred shares. And I used a 2 point stop and a 2 point initial profit target. and I set a limit for 102 points up, and then had a trailing stop for 2 points down. Okay, and when that limit gets hit, there's nothing else to do once you put those orders in. In fact, if you put those orders in and the limit gets hit, that trailing stop is going to take you out. If it doesn't take you out, you just get out by the close. So you can see I exited on the close. There's the actual trades there I took. This is in my model account. I will do the ogres and any other thing I throw out to my Facebook group. By the way, if you see me throw something out to the Facebook group, it's something that I'm seriously considering, and then I'll tell you whether or not I'm taking it, provided it doesn't trigger quickly or something like this one did. But anyway, so 280 on the first loaf, 274 on the second loaf. That was on the close. Now that was only 100 shares, but that's $500, $550. That's better than the poke of the eye. Now, I hate to do the fuzzy math, but let's do a little fuzzy math. If you could do that every day, and you can't, believe me, but just to get your head wrapped around annualization, that would be like 140,000, probably 139 and change, but close enough, $140,000 extra. Obviously, you can't do this every day. But if you waited, an opportunity like this will present itself. And again, you can't just look at it and say, "Oh, the spread's too big. I'm not going to take it," and then go about your life. You need to put in maybe an alert, and I think that's what I did. I put an alert for when it began to break out, so I would check it once again. And by that time, the spread began to narrow. Anyway, I think it would behoove you to use a slightly longer term chart. And I found this by complete accident, and that's how I worked my way up to 30-minute charts. And so you can see it's a little more cut and dry. That first 30-minute bar, if you look at the 5-minute bar, it's just doing this, okay? But if you look at the 30-minute bar and you're not watching every tick, it's like, oh, okay, it looks like it sold off fairly hard the first 30 minutes. And then it begins to work its way higher. And when it breaks out above that opening range, a la Toby Crable, opening range breakout, you look to get long.